Most people are shocked when they find out Social Security is actually taxable. They're even more shocked whenever they realize it's not because they did something wrong, it's because of decisions that they made years earlier, often without realizing those decisions would affect how much of their Social Security they would actually get to keep eventually. I've had people tell me, I thought Social Security was tax free. Others say, I thought only high income earners paid taxes on it. Well, neither of those are true. Both of those are understandable assumptions, but both are actually normally wrong. Because for many retirees, up to 85% of your Social Security benefit can be subject to federal income tax. And the reason, it isn't because of your Social Security benefit itself, it's how that benefit interacts with everything else in your financial picture. In this video, we're going to talk about how Social Security is taxed, why these thresholds catch many people off guard, and why tax planning, not claiming strategy alone, often determines how valuable your benefit actually is. This is the 6th video in our Social Security series, so if you haven't watched our overview video or you've missed out on any of the other episodes in the series, make sure to click that card that's going to pop up over my shoulder, because you don't want to miss any of the important details we've already talked about. This video is not about memorizing tax formulas. It's about understanding where the pressure points are so you can recognize when this deserves coordination instead of just assumptions. And spoiler alert, that's going to be the case the majority of the time. I'm Jacob Euler, co-owner of Grand Summit Wealth Management. I work with high-income individuals, families, and business owners, and I've helped over 100 different clients transition into retirement by coordinating decisions like Social Security with taxes, portfolio income, and long-term planning. This channel is called 1% Wealth Secrets because at higher levels of wealth, outcomes are rarely determined by one decision. They're determined by how decisions stack. And if you have a financial topic you would like us to discuss, make sure to comment that below and we'll try to make a video to help you out on that. So let's start with the basic framework. Social Security isn't taxed directly. Instead, the IRS looks at something called provisional income. Provisional income includes your adjusted gross income, tax-exempt interest, and half of your Social Security benefit. Based on that number, the IRS determines whether 0%, 50%, or up to 85% of your Social Security benefit is subject to federal income tax. Here's what that actually looks like in real numbers. For single filers, if your provisional income is below $25,000, 0% of your Social Security is taxable. Between $25,000 and $34,000, up to 50% of your benefits are taxable. And above $34,000, up to 85% of your benefits are considered taxable. Now, that doesn't mean 85% of your benefit goes away. It just means that 85% of your Social Security benefit gets added to your taxable income, and then you would pay taxes according to whatever tax bracket you fall into whenever you file your taxes for that year. Now, for married couples filing jointly, these numbers look a little bit different. If your provisional income is below $32,000, your Social Security benefit is not taxable. Between $32,000 and $44,000, 50% of your total benefits are considered taxable. And above $44,000, 85% of your benefits are considered taxable. Now, here's the part that surprises most people. These income thresholds were set way back in the 1980s, and they've never been adjusted for inflation. Your benefits get adjusted every year with the cost of living adjustment, like we talked about in an earlier video in our series, to help try to offset inflation a little bit, but these tax threshold brackets have never changed. And that means more retirees cross them every single year, even if you don't feel wealthy. I mean, think about it. Does $44,000 sound like enough to live on in retirement at this point? I know some people do it, depending on your cost of living, your lifestyle, all of that. But do the majority of people live on that? No, it normally takes more. Let's look at a real-life scenario to drive this point home. Take a retired married couple. They receive $40,000 per year in combined Social Security benefits. They also withdraw $90,000 per year from a mix of IRA and brokerage accounts to support their lifestyle. On paper, they think our income is about $130,000. That feels reasonable for our lifestyle and our retirement goals. But once that provisional income is calculated, a large portion of their Social Security benefit becomes taxable. Depending on how those withdrawals are sourced, up to 85% of their Social Security, over $35,000, may be considered taxable income. That doesn't mean Social Security caused the tax, it means Social Security exposed that tax. Now here's where the planning really matters, because not all dollars are treated equally in this provisional income calculation. Withdrawals from traditional IRAs or brokerage accounts increase the provisional income in your calculation. However, Roth IRA withdrawals or any tax-free loans taken from a permanent life insurance policy like an IUL or a VUL also do not count. Municipal bonds interest does count even though it's otherwise considered tax-free. So for two identical households with the same spending and the same Social Security benefit, they can both have way different tax outcomes purely based on how that income is sourced, if it comes from IRA and brokerage versus if it comes from tax advantage accounts. This is why I'm always cautious when people focus exclusively on maximizing the Social Security check. If you maximize the benefit but ignore taxes, you may still lose a meaningful portion of it every single year. And for many high-income households, this opportunity shows up earlier before collecting Social Security even begins. It could even begin as young as your 20s and 30s, the outcome of that down the road. But the good news is, there's still time in those early retirement years to make changes, because the window between when you stop the work and when you start required minimum distributions can be a window for tax planning. That's where strategies like Roth conversions are often evaluated. Not because they are universally good in every situation, but because they can reduce future provisional income and smooth your taxes out later. Again, this isn't about tactics in isolation, it's about sequencing. Social Security taxation isn't a surprise tax, it's really a coordination tax, or more so, a lack of coordination tax that causes this to pop up. How much of your benefit you keep often depends less on Social Security rules and more about decisions made on your accounts and withdrawals and timing made years earlier. So for many of the families and business owners we work with at Grand Summit Wealth Management, Social Security taxation is evaluated alongside portfolio income, Roth strategy, and long-term tax exposure, not as a standalone issue. So if you're approaching retirement, or you're already there and you're wondering, why does my tax bill feel higher than I expected it to be? This is usually going to be one of the first places to look. If you would like help evaluating how Social Security taxes and income strategy interact with your situation, you can schedule an optional financial consultation using the link below. There's no obligation, it's simply a conversation to determine whether guidance would add value for you. So in the next video, we're going to talk about how Social Security fits into a broader retirement income plan, how it coordinates portfolio withdrawals, longevity risk, and why income planning looks very different at higher levels of wealth. So at this point in our series, we've spent 6 videos talking about the individual rules and pieces of Social Security. Now, we're going to start putting those pieces together in the form of a plan. So thank you for sticking to the end of this one, and make sure to watch out for the next video, and we'll see you in the next one.